Hey everybody, welcome to Refinitiv LPC's weekly videocast. My name is Fran Byers. I am the head of analysis covering middle market loans at Refinitiv LPC.
I'm David Brooke. I'm a reporter covering the middle market at Refinitiv LPC.
And my name's Andrew Hedlund. I am also a reporter covering the middle market at Refinitiv LPC.
So it's been a very busy and very interesting earnings season for the BDCs for the quarter ending 3/31. We wanted to give you a brief rundown of the biggest themes to surface so far throughout the earnings season. As you can see here by all the headlines on the slide, our journalists have been extremely busy covering all the earnings calls. And if you're interested, you can check out all these stories on loanconnector.com.
Of course, all of these reports here are up until March 31st. So the economic effects of COVID-19 shutdown was only beginning to impact the middle market. But as we discussed in the previous episode, we've seen the dividend cuts across the board, a trend we anticipated, and we're seeing BDCs shore up their sort of portfolio health. Leverage has spiked as a result, and we'll get into that later.
And obtaining sufficient liquidity has been a big topic for managers and investors alike. Later, we can get into how BDCs have responded and the creative ways of sourcing funding they've taken.
Yep. But first and foremost, credit quality deterioration driven by the COVID-19 shutdown has been the biggest topic on the calls, with almost the entire industry reporting NAV per share declines quarter over quarter. This chart here illustrates that BDCs are reporting a pretty big range in NAV per share declines, from as severe as a 35% drop to as minimal as only 5%. The average for the industry is at about 14% right now, which is pretty much in line with what the equity analysts predicted. But this does beg the question of why is the dispersion so wide? And of course, NAV per share is driven by two major factors. One, a pickup in non-performing or non-accrual loans, and two, unrealized losses from mark-to-market declines in the value of the loans. So you can see here in the chart on the left that the average portfolio non-accrual rate has spiked to about 5.5% so far in 1Q20, up from 3.4% last quarter. That is the highest level we've tracked post-credit crisis, and this level is probably only going to climb further as the quarters progress. And you can see in the chart on the right what percentage of debt assets within BDC portfolios are marked below 85. Anything marked below 85% is likely a pretty good barometer for distressed loan. And on average, about 12% of the BDC portfolios at 3/31 have loans marked below 85. And when we drill into these loans using BDC collateral, we can see that the most prominent sectors to show large write-downs quarter over quarter included energy, services, healthcare, retail supermarkets, manufacturing, automotive, and beverage and food processing. Also quite interesting is that we can take the same loan held across different BDCs and see that the managers are marking them very differently this quarter. In times of economic hardship, the disparity in marks becomes even more apparent. Now, this highlights a struggle that many investors have with the BDC space, in that the marks can be subjective, and some BDCs are simply slower to mark loans down than others. Even though many of the managers on the call will tell you they get their marks analyzed by third-party valuation firms, the BDCs and their boards still have a lot of leeway in the share of the portfolio they value externally and in the values they use. Now, while most of the marks do appear to be within 2 to 3 points of each other, we can see some dispersions here be as wide as 5 to 10 points, which is meaningful to an equity investor.
So this brings us to the next point of how BDCs will manage their credit deterioration over the next few months and what they will be doing to shore up their balance sheet. Of course, liquidity has become paramount in this period of volatility, and the BDCs have taken a variety of measures to address their capital needs. Raising money has been the focus, though the question is how to do it in the most shareholder-friendly manner to avoid dilution, or at least minimize it, given that most of the universe is still trading well below book value, as you can see on this chart. Carlyle's BDC has sold $150 million in mainly middle market loans post-quarter end and received a $50 million preferred equity infusion from its advisor. Now, Blackstone's BDC increased its revolver to make new investments. In addition, Blackstone's fund is in a unique position because it is not fully ramped, meaning that it has a large amount of uninvested equity. Also, the BDCs from Bain and Golub had previously announced rights offerings as a means of generating liquidity. Both firms will partially use those proceeds to pay down debt. Bain said it is seeking to raise slightly more than 120 million, while Golub reported its rights offering was oversubscribed and will raise around 300 million. In addition to the rights offering, the larger Golub Capital platform brought in an impressive $3 billion haul across myriad vehicles that included its most recent private BDC. In addition, BDCs have addressed liquidity needs by eliminating expenditures, which has included halting share buyback programs. BDCs from Crescent and Apollo have done this. In addition, Crescent secured additional leverage capacity when its shareholders approved a 2-to-1 debt-to-equity limit. Capital structures have come into focus as well during this period of volatility, and unsecured debt is being viewed in a favorable light. In that scenario, a BDC has fewer pledged assets. Golub said it may tap the unsecured markets once they open up again and become more cost-effective, while Crescent received an investment-grade rating, which could also let it tap the unsecured markets.
And this brings us to the next slide, which outlines how leverage has skyrocketed across the market. You can see the sort of more highly levered BDCs and least levered BDCs, but at an average of 1.25 times leverage, this is a sort of record for us as we've tracked it according to Refinitiv LPC. Leverage is proven to be a life jacket for BDCs. If you cast your mind back to the when restriction was lifted to 2-to-1, and we had many market commentators say at the time that we're unlikely to see bad BDCs ratchet up to 2-to-1. The measure at that time was more likely to help BDCs boost income as they were looking into rotating in less risky senior loans. But we're now in a new world, and we're seeing BDCs now rely on leverage to help them get through this crisis. BDCs have also kind of tripped up on that 2 times leverage limit. So Garrison very recently reported a 2.54 times regulatory leverage, putting the lender in breach of the 2 times limit mandated by the SEC. Bain Capital and Pennant Park saw leverage levels at 1.86 and 1.65 respectively, ticking up from 1.55 and 1.41 reported in the fourth quarter. New Mountain at 1.56 and Monroe at 1.47 are above their ranges of around 1.2 to 1.3 times, which is the target. Leverage spiking is a broad trend across the BDC market. And you've seen others without the 2-to-1 limit approval, such as Owl Rock and Prospect, are moving swiftly to increase it and bring them in line with the rest of the market. Prospect, of course, embraced the SEC's relief measure to use Q4 valuations to determine leverage levels. These are unusual times, and many reported this increase is due to NAV decline, markdowns on assets, as the COVID-19 takes its toll on the US economy. This, combined with reduced deal activity, is hitting fee income, meaning that BDCs are feeling it at both sides. In second quarter results, we may see more BDCs hit that 2 times limit once a full 3 months of COVID-19 has taken its toll on the middle market. And another effect of the kind of development of COVID-19 is the botched mergers that we're seeing. So Goldman Sachs BDC very recently announced that its merger between the Goldman Sachs BDC and the middle market lending BDC is to be put on hold. Termination date is December 9th, 2020. So we still have time for that to go forward. Sierra and Medley have also abandoned their planned merger.
Thank you, Andrew and David, for your amazing coverage. It does seem that Q1 was a pretty rough quarter, but it also seems that Q2 is only going to be harder. So we want to thank you all for listening, and we hope you do stay tuned as we cover this market. Be sure to check out all our BDC earnings highlights on Loan Connector or BDC Collateral. You can also follow Andrew, David, or myself on Twitter. Stay safe, everybody.